All right, so today we're going to really unpack this world of venture capital and startup financing.
Okay.
You've given us really a ton of material to work with, including these excerpts from Venture Deals by Brad Feld and Jason Mendelson.
Yeah.
But I think the goal here is to really kind of break it down, especially, for someone like you who's already pretty familiar with the basics of how this whole ecosystem works.
Yeah, and what's really interesting is how much this world has changed.
Right.
It used to be,
Yeah.
a lot simpler, fewer players,
Right.
less complex deal structures, and now it's just a whole different ballgame.
Yeah, so like any good game,
Right.
let's start by figuring out who the players are.
Okay.
Right. And Venture Deals talks a lot about the importance of
Yeah.
understanding everyone's roles and motivations in all this.
Right, and it's not just entrepreneurs and VCs. You've got angel investors, you've got lawyers, mentors. I mean, it's a whole cast of characters.
Okay, so let's break it down.
Okay.
We've got the entrepreneurs, obviously the ones with the big ideas.
Right.
Then you've got the VCs, the ones with the money.
Right.
But even within, like, VC firms,
Yeah.
it's not always clear who's actually making the decisions, is it?
That's a great point, and it's really important, I think, to understand the hierarchy within a VC firm
Yeah.
because it really impacts who you're negotiating with, right?
Exactly.
So you've got the managing directors or MDs at the top,
Mm-hmm.
then you've got the general partners or GPs,
Right.
and then you've got this whole sort of ladder of more junior folks like principals, associates, analysts.
Almost like a corporate ladder.
It is,
But for
venture capital,
Yeah,
right?
venture capital.
And just like in any organization, the level of authority, decision-making power, that all changes as you climb that ladder.
Right.
And Venture Deals really emphasizes that you've got to know who can actually say yes to a deal.
Yeah.
You don't want to be spending all your time pitching to someone who
Right.
ultimately can't make the decision.
Right. You don't want to be stuck in the no man's land
Right.
of endless meetings without any progress.
Exactly.
And to make it even more confusing, I think, there's been some title inflation in the VC world too, right?
Oh, absolutely.
Venture Deals mentions that what used to be called an associate might now be called a partner.
100%.
So just because someone has a fancy title
Yeah,
doesn't mean they actually have
right.
the authority to
Right.
write you a check.
Exactly. You got to look beyond the titles and understand the actual decision-making process within the firm.
So do your homework. Don't just be swayed by a fancy title.
Right.
Now we talk the angel investors for a minute.
Okay.
Venture Deals describes them as, this crucial source of early-stage funding,
Yeah.
often coming in even before traditional VCs.
Wow.
Like they're the, the seed that helps the plant sprout.
That's a good analogy.
Yeah.
Um,
Angel investors are typically high net worth individuals who invest their own money.
mhm. And they're often attracted to companies that are either too early
Right.
or too risky
Yeah.
for traditional VCs.
Yeah.
So they can be a real lifeline for entrepreneurs
That's
who are
her-
just getting started.
But there are some rules around who can actually be an angel investor, right?
Yes.
Like it's not just
Yes.
anyone off the street can decide.
No, they have to be what's called accredited,
Right.
meaning they meet certain income and net worth requirements that are set by the SEC. And this is really designed to protect investors,
Yeah.
right? Make sure that they can handle the risks
Right.
that come along with early stage investing.
It's like a safeguard to make sure people aren't putting all their eggs in a very risky basket.
100%.
And what's interesting is Venture Deals also points out that the Jobs Act of 2012, which was meant to simplify things, actually made angel investing more complex in some ways.
Yeah, that's
It's interesting how,
it is interesting.
like, sometimes the more you try to
yeah,
make things easier,
yeah,
it just adds more
add more complexity.
complexity. Yeah.
So the Jobs Act, right, aimed to make it easier for startups to raise capital
Right.
and for more people to participate
Mm.
in the process, which is a good thing.
Yeah.
However, it also introduced a whole new set of rules and regulations
Right.
that can be tricky to navigate, as Venture Deals points out.
Yeah.
For example,
Yeah.
the rules around general solicitation and advertising, like all that changed.
So even though the intention was to open things up, it also kind of added this layer of complexity
Yeah,
to the process
added a layer of complexity.
that people now have to kind of wade through.
Absolutely.
So, okay, we've got our players, we've got our entrepreneurs, we've got our
Mhm.
VCs, we've got our angel investors.
Yep.
Let's talk about the actual process of raising money.
Okay.
So you've got this amazing startup, you've got your world-changing idea.
Mm-hmm.
Where do you even begin?
Well, as venture deals emphasizes, you need a really solid fundraising strategy.
Right.
And a key part of that strategy is understanding the language of these financing rounds,
Okay.
right?
Yeah.
Seed, Series A, Series B, and so on. It's like climbing a mountain.
Hmm.
Each round is a base camp
Right.
on your way to the top.
So it's not just about getting any funding.
Right.
It's about getting the right kind of funding at the right time.
100%. And
And what does venture deals say about how those labels actually relate to a company's stage
right.
and growth?
So it explains that a seed round
Yeah.
is typically the very first institutional investment
Okay.
company receives.
Hmm.
And it's really used to get the business off the ground,
Okay.
develop the product or service, and start building out a team.
Got it.
Then comes Series A, which is for companies that have proven their concept and
Right.
are really ready to scale their operations.
Okay.
Series B is further expansion and so on.
Mm-hmm.
Each round typically represents, a larger investment.
Yeah.
And it signifies that the company has reached certain milestones.
So it's not just about slapping a random letter on a funding round.
Right.
It's about demonstrating that you've made progress.
Right.
And that you kind of align
Yeah.
with the investor's expectations at each stage.
100%. And understanding this sort of alphabet soup, as you called it,
Yeah.
is crucial for targeting the right investors.
Right.
Right. If you try to pitch a Series B investor,
Mm-hmm.
when you're still at the seed stage, it's like showing up to a marathon when you've only trained for a 5K.
Yeah.
You got to be in the right race.
Makes sense.
You got to match your fundraising efforts to the right type of investor.
So, okay.
Speaking of which,
Not all VCs are created equal.
right.
Right. Venture deals.
We touched on that before. Yeah. Dives into the different types of VCs,
Mhm.
each with their own investment focus and strategies.
Okay, let's unpack those a little bit further.
Okay.
What exactly are micro VCs all about?
Yeah.
They sound kind of like the,
Yeah.
I don't know, the venture capitalists of the venture capital world.
That's a great way to put it.
A little bit.
So they often manage smaller funds, maybe less than 15 million.
Mm-hmm.
And they tend to focus on those very early stage investments. They might be run by former entrepreneurs
Right.
or angel investors
Okay.
who really have a deep understanding of the challenges
Yeah.
that startups face.
So they're like the experienced mentors who have been there, done that,
Exactly.
kind of seen it all.
And because they work with smaller funds, they're often more willing to take risks
Okay.
on unproven companies and ideas.
Okay.
And they also tend to be very hands-on, providing mentorship and guidance in addition to capital.
That can be incredibly valuable.
Yeah.
Especially for first-time founders who are really navigating uncharted territory.
Yeah, for sure.
So, okay, so what about when a company is ready to scale up
Yeah,
and they need a bigger investment?
right.
That's where traditional VCs come in, right?
Yeah, so traditional VCs manage much larger funds,
Right.
sometimes hundreds of millions, even billions of dollars.
Wow, okay.
They invest across a wider range of stages, from seed to late-stage growth,
Got it.
and they're really looking for companies with high growth potential
Mhm.
that can generate significant returns, kind of swinging for the fence.
They're playing a different game altogether.
Totally different game.
Yeah, they're looking for those home runs.
Absolutely.
Now, what about CVCs? You
Right.
mentioned that they're part of larger corporations.
Right.
How does that impact their investment strategy?
So that's a key point.
Mhm.
Unlike traditional VCs, CBCs often have strategic objectives in
Okay.
addition to financial returns.
Right.
So they might be looking for a startup
Yeah.
that can enhance their existing products or services,
Okay.
give them access to new technologies or markets,
Mhm.
or even help them acquire talent.
Got it.
So they're thinking about how the investment fits into the bigger picture of their corporation.
So it's not just about the money for them.
No.
It's about finding those startups
Yeah,
that can help them achieve those strategic goals.
exactly. But that also could mean
Right.
potential conflicts of interest, right?
Right. Absolutely. Yeah.
Something entrepreneurs need to be aware of.
Yeah.
For example,
Yeah.
a CBC might invest in a startup that's a potential competitor to their parent company,
Yeah.
right? Or they might pressure the startup to make decisions that benefit the parent company,
Right.
even if it's not in the best interests of the startup.
So it's crucial for entrepreneurs to be aware of those potential conflicts.
Yeah.
And to really negotiate terms
Yeah.
that protect their own interests.
100%.
Now, finally, we have strategic investors.
Yeah.
Are they similar to CDCs?
They are similar in that they're typically large corporations looking for those strategic synergies.
Okay.
However, unlike CBCs, they might not have a dedicated venture capital arm.
Right.
right? They might make these strategic investments in startups that align with their core business,
Right.
kind of on a more ad hoc, case-by-case basis.
Got it.
It's like, hey, this startup is doing something that could really benefit our business.
Right.
Let's invest.
So like a car company investing in a self-driving technology startup
Exactly.
or a media company
Yeah.
investing in a content creation platform.
Right.
They're looking for that competitive edge or a way to expand into new markets.
100%. And just like with CVCs, it's crucial for entrepreneurs to understand
Right.
the motivations of strategic investors
Yeah.
and to really negotiate terms that are beneficial to both sides.
Makes sense.
But understanding the different types of investors is just the first step.
Right.
You then need to craft a compelling pitch
Right.
to get their attention.
So you have this amazing startup. You've got this world-changing idea.
Yeah.
You've figured out who you need to talk to.
Right.
What does Venture Deals say about actually developing a fundraising strategy?
So Venture Deals really stresses the importance
Yeah.
of a killer pitch deck and a concise executive summary.
It's like the first date.
It is.
You got to make a good first impression.
You got to make a good impression because investors are bombarded with these pitches every single day.
Yeah.
You need to grab their attention and very clearly articulate why your startup is worth their time and money.
So it's not just about having a great idea.
No.
It's about presenting it in a way that resonates with those investors.
100%. 100%.
What kind of advice does Venture Deals actually give on crafting that pitch?
It emphasizes that your pitch needs to be crystal clear, concise, and tailored to the specific investor you're pitching to.
Right.
What resonates with an angel investor might fall flat with a traditional VC.
Makes sense.
And if possible, having a demo or a prototype can be hugely beneficial.
Right.
VCs love to see things in action.
Showing beats telling.
Right. 100%.
Always. Okay. And even with a killer pitch, even with a demo, you still need a solid financial plan, right?
Absolutely. Now, the authors of Venture Deals are very upfront about the fact that financial predictions for startups are almost always wrong.
Right.
In fact, they say the only thing we know about financial predictions of startups is that 100% of them are wrong.
Well, that's reassuring. So what's the point of even creating a financial model if you know it's going to be wrong?
That's where it gets interesting.
Okay.
Right.
Yeah.
Even though the predictions themselves might not be accurate, the process of creating a financial model forces you to think through the financial aspects of your business.
Got it.
It helps you understand your costs, your revenue streams, your path to profitability, even if the numbers themselves change along the way.
So it's more about demonstrating that you have a grasp of the financial side rather than trying to predict the future.
Exactly. And it also helps you think about your burn rate, right?
Yeah.
Which is how much cash you're spending each month.
Right.
VCs want to see that you're using their money wisely and not burning through it too quickly.
Yeah. So you have your pitch, you have your financials, you have your demo. You're ready to start meeting with these VCs.
Okay.
What's the key to navigating those conversations and making sure you're choosing the right partners?
I think that's a crucial point.
Yeah.
You know, you're not just pitching your idea, you're pitching yourself.
Right.
VCs invest in people as much as they invest in ideas.
Yeah.
Right? They want to see that you're passionate, that you're knowledgeable, that you're capable of leading this company to success.
So it's about building a connection and demonstrating that you're the right person to steer the ship.
Yes.
But how do you actually know if a particular VC is a good fit?
That's where doing your homework comes in, right? So you want to research their investment philosophy, their track record, their reputation in the industry.
Okay.
Look at their portfolio companies and see if there are any similarities to your business.
Right.
Venture Deals highlights a very interesting point, I think, about this relationship.
Oh, what's that?
Between a VC and a founder.
Yeah.
They say that the average length of a relationship between a VC and a founder is comparable to the average length of a marriage.
Wow.
In the United States.
So you're basically getting hitched.
You kind
of your investors.
Yeah.
A little bit.
It's a long-term commitment, so you need to choose your partners carefully.
Right. And it's a commitment on both sides, right?
On both sides, absolutely.
Yeah.
Look for VCs who share your vision, who understand your industry, who have a good track record of supporting their portfolio companies.
So it's like dating, but with higher stakes.
That's a great way to put it.
And just like in dating, I guess, it's helpful to create a little bit of competition.
A little bit.
If you have multiple VCs that are interested, it gives you more leverage in the negotiations.
Yeah, absolutely.
Oh, the power of choice.
The power of choice.
So Play the field a bit, but don't be afraid to commit when you find the right match.
Exactly.
Okay.
Now, once things start to get serious
Yeah.
and an investor's really interested, you're going to get what's called a term sheet.
Okay, so the term sheet, it's kind of like the prenuptial agreement of the startup world.
That's a pretty accurate analogy.
Yeah.
It's more than just a piece of paper, right?
Right.
It's the blueprint for your relationship with your investors.
And according to venture deals, it all boils down to two key things.
Right.
Economics and control.
Economics and control, exactly.
So let's break those down.
Okay.
What exactly do we mean when we say economics?
Yeah.
In the context of a term sheet.
Economics refers to the financial aspects of the deal.
Okay.
Right. So how much money are the investors putting in? What percentage of the company are they getting in return?
Right.
And how will they get their money back?
Yeah.
If the company is sold or goes public.
So it's all about the money, honey.
Well, yeah, but it's also about structuring the deal in a way that's fair to both the founders and the investors.
Right, because ultimately you both want the company to succeed.
You both want it to succeed.
Right.
100%.
Okay, so that's economics.
Yep.
What about control?
So control refer to the mechanisms that give investors a say in how the company is run.
Got it.
This includes things like board seats, voting rights, protective provisions, which give investors veto power over certain company decisions.
So it's about who gets to call the shots.
Yeah.
Or at least have a
strong voice.
Strong voice in the decision-making process.
Exactly. And finding that right balance of control between founders and investors can be a very delicate dance.
Right.
Right?
Yeah.
Too much investor control can stifle the company's growth and innovation.
Right.
Too little control can make investors nervous about the direction of the company.
So it's about finding that sweet spot where both sides feel both sides.
Comfortable and empowered.
Absolutely.
Okay, so we've talked about the players, we've talked about the fundraising process, we've talked about the importance of the term sheet, but I know there are a lot of specific provisions within the term sheet that we really need to understand.
We need to unpack.
So let's dive into those in the next part of our deep dive.
Let's do it.
All right, so we're back and ready to tackle this term sheet, the blueprint for your startup's relationship with investors.
Right.
It could be a little daunting, kind of like trying to decipher ancient hieroglyphics, but venture deals.
Yeah. Does a pretty good job of breaking it down.
It does. It's where the rubber meets the road, the term sheet, right? It lays out all the key terms of the investment, including things like valuation, ownership, control.
And we talked about how it all kind of boils down to economics and control.
Right.
But, within those categories, there are a bunch of specific provisions that entrepreneurs really need to understand.
There are.
And one of the most crucial, according to venture deals, is liquidation preference.
Right.
They spend a lot of time on this one.
They do, and for good reason.
So what is liquidation preference and why is it so important?
So liquidation preference dictates how the proceeds are distributed if the company is sold or liquidated.
Okay.
It determines who gets paid first and how much.
So it's all about who gets their slice of the pie first and how big that slice is.
Exactly. And there are different types of liquidation preferences, each with its own implications.
All right.
The most common type is a simple liquidation preference.
Okay.
In this scenario, investors get their money back first before common shareholders, which typically include the founders and employees, see a dime.
So the investors get their money back and then everyone else splits whatever's left.
Exactly.
Okay.
Sounds straightforward enough.
Yeah.
But then you have participating preferred.
Okay.
Which means investors not only get their initial investment back, but they also get to participate in the remaining proceeds alongside the common shareholders.
So it's like having your cake and eating it too.
It is. It's much more investor friendly because they get a piece of both pies, so to speak.
Got it.
And then there's non-participating preferred, where investors have to choose. They can either take their initial investment back or convert their shares to common stock and participate in the distribution alongside everyone else.
So it's a bit of a gamble depending on how big the exit is.
It is.
And what the overall pie looks like.
Absolutely.
Okay.
To really understand how this plays out,
yeah,
let's look at a simple example.
Okay.
Imagine a company raises $5 million at a $10 million pre-money valuation.
Okay.
This means the investors own a third of the company.
Got it.
Now, let's say the company is sold for $15 million with a simple liquidation preference.
Yeah.
The investors would get their $5 million back first.
Right.
The remaining $10 million would be distributed to the common shareholders.
So in this case, everyone gets their initial investment back.
Exactly.
Okay.
Clean split.
Now, let's say the company is sold for $25 million.
Okay.
So a much bigger exit.
Yes. With a simple liquidation preference, the investors still get their $5 million back first.
Right.
But now there's $20 million left to distribute to the common shareholders.
So the investors get their money back and everyone else benefits from the bigger pie.
Absolutely.
Got it.
But with a participating preferred structure, the investors would still get their $5 million back first.
Right.
But then they would also participate in the remaining $20 million.
Right.
Based on their ownership percentage, which is 33%.
Okay.
So in this case, they get an additional $6.6 million.
Wow.
On top of their initial $5 million.
So that's why understanding liquidation preference is so crucial.
It's huge.
Yeah.
It can have a major impact on who gets what in an exit.
All right. So liquidation preference is all about how the pie is sliced up.
Yeah.
What about anti-dilution protection?
Okay.
That sounds kind of like a shield against dilution.
It is.
So
anti-dilution protection safeguards investors' ownership stake.
Okay.
If the company raises money at a lower valuation later on.
Got it. So if the company's value takes a dip, this provision kind of helps the investors avoid getting too diluted by ensuring that they still own a decent chunk of the company.
Right. There are different types of anti-dilution protection.
Okay.
But the most common is weighted average anti-dilution.
Okay.
This takes into account both the price and the number of shares issued in the down round to adjust the conversion ratio of the preferred stock.
Okay.
Giving investors a larger percentage of the company.
So it's like a rebalancing act to make sure everyone's stake is adjusted fairly if things go south.
Right. There's also ratchet-based anti-dilution, which is more aggressive. With this, the conversion price is simply reset to the price of the down round.
So weighted average is more balanced.
Yeah.
Ratchet-based is kind of like hitting the reset button for the investors.
That's a good way to think about it.
And the type of anti-dilution protection included in the term sheet can really significantly impact the economics of the deal, especially in the case of a down round.
For sure.
So another one of those crucial terms to understand and to really negotiate carefully.
Absolutely.
Okay, so we've talked about, how the pie is sliced up.
Right.
Now let's talk about the question of control.
Okay.
And one of the key areas where control comes into play is the board of directors. Who sits on the board.
Right.
And how do they make decisions?
Yeah, the board of directors has a significant influence on the company's direction.
Right.
It's responsible for major decisions.
Yeah.
Like hiring and firing executives, approving budgets, even deciding whether to sell the company.
Wow.
And Venture Deals points out that getting the board composition right is essential.
It sounds like having the right board is really crucial.
It is.
But how is the board actually structured?
So the structure and the composition of the board are laid out in the term sheet.
Okay.
It specifies how many seats each side gets.
Okay.
The investors and the founders.
Right.
And often includes independent directors as well.
Independent directors, so they're not affiliated with either the investors or the founders.
Exactly. Independent directors are supposed to be impartial and act in the best interests of the company as a whole.
Got it.
They can be a really valuable asset in providing objective perspectives and mediating any potential conflicts between founders and investors.
So it's like having a neutral party
at
the table to make sure everyone's voice is heard.
Right.
But what about the actual decision-making process? Like, does everyone on the board get an equal vote?
That's where things can get interesting.
Okay.
The term sheet also outlines the voting rights of each board member.
Got it.
Right. It might specify that certain decisions require a supermajority vote.
Okay.
Or that certain board members have veto power over specific matters.
So it's not just about the number of seats each side gets, it's about the power that those seats hold.
Exactly. It's like a game of chess.
Right.
Where each piece has its own strategic value.
Yeah, exactly. And this is where protective positions come in.
Yes.
And these give investors veto power over certain company actions, even if they don't have a majority on the board.
Right.
Venture Deals gives some examples of actions that might require investor approval.
Right.
So it's like having a trump card that investors can play if they feel like their interests are at stake.
Exactly. Protective provisions can cover things like issuing new shares, incurring debt, selling major assets, or even changing the company's business plan.
Got it.
They act as safeguards for investors, ensuring they have a say in decisions that could significantly impact the value of their investment.
Yeah, and I can see how that would be important for investors, but could it also stifle the company's ability to
Yes.
be nimble and move quick?
Like could.
Yeah.
That's the potential downside,
Right.
right? If investors are too heavy-handed with their veto power, it can create friction and slow down the company's progress.
Right.
So that's why it's crucial to negotiate these protective provisions very carefully.
Yeah.
Striking a balance between protecting investor interests and allowing the company the flexibility it needs to grow.
So it's all about finding that delicate balance again, making sure that the company can thrive without leaving the investors feeling vulnerable.
100%.
Okay, so now alongside these, kind of more traditional equity financing terms,
yes,
there are a couple of other fundraising avenues that Venture Duels explores that have become increasingly popular. We're talking about things like convertible debt and crowdfunding.
Right.
They're kind of like the new kids on the block in the fundraising world.
They are.
Convertible debt in particular seems to be all the rage these days.
Yes.
What is it exactly, and why has it become so popular?
So Venture Deals explains that a convertible note is essentially a loan that converts into equity at a later date, typically during a future funding round.
Got it.
So it kind of sits somewhere between debt and equity, which can be appealing to both entrepreneurs and investors, especially in the early stages.
So it's kind of like kicking the can down the road when it comes to valuation.
It is. It avoids the sometimes difficult and lengthy process of negotiating a valuation upfront, which can be beneficial for startups who are still in their early stages and may not have a clear picture of their worth.
Yeah, so it's a faster and simpler way to get funding.
Yes.
When you need it most.
Absolutely.
Without getting bogged down in these really complex valuation discussions.
And because you're not setting a price up front, it can be attractive to both sides. Investors get to wait and see how the company performs before they determine the final price of their equity. While entrepreneurs can avoid potentially undervaluing their company too early in the game.
Sounds like a win-win.
It can be, but as with anything, there are potential downsides. And Venture Deals points out one of the big ones, which is if the company performs really well, before that next funding round, the convertible note holders might end up getting a much sweeter deal than they would have in a priced equity round.
So it's a gamble.
It is.
If the company takes off, you might end up giving away more equity than you intended.
Absolutely. But of course, there's also the opposite scenario where if the company doesn't perform as well as expected, the convertible note holders are still entitled to get their money back, plus interest.
So it's a double-edged sword.
It is.
With both upside and downside potential. Okay.
But regardless of the potential risks, the mechanics of convertible debt can be a little tricky to grasp.
Okay, so let's break down how it actually works.
Okay.
When and how does the debt actually convert into equity?
So Venture Deals explains that the most common trigger is what's called a qualified financing, which is usually a priced equity round of a certain size.
Got it.
So when that happens, the convertible note converts into equity at a discount to the price of that round.
So the note holders are rewarded for taking on that early risk by getting a better price than those new investors coming in.
Exactly.
During that equity round.
And that discount is typically somewhere between 15% and 25%.
Got it.
But there's another important element here called the valuation cap.
Ah, yes, the valuation cap. This is where it starts to get a little more complex.
A little.
So what is a valuation cap and why is it so important?
So a valuation cap sets a maximum price at which the convertible note will convert regardless of the actual valuation in that qualified financing. It's a way for investors to protect their upside potential if the company's valuation skyrockets between the time they invest and the time the note converts.
So it's like a safety net for the investor.
Yeah.
Making sure that they don't miss out on the potential gains if the company's value just explodes.
Yes.
Okay.
Now, to understand how this works in practice, let's look at a hypothetical example from Venture Deals.
All right.
Imagine a company raises $1 million in convertible debt with a 20% discount and a $5 million valuation cap.
Okay, I'm following so far.
Now, let's say the company just crushes it and raises a series around at a $10 million pre-money valuation without the valuation cap. The convertible note would convert at a 20% discount to that $10 million valuation, which would be $8 million.
So the note holders are getting a pretty good deal already.
They are, yes. But because there's a $5 million valuation cap, the note converts at that lower price.
Got it.
This effectively gives the note holders a much larger ownership stake than they would have gotten at that $8 million conversion price.
So the valuation cap really does act as a ceiling.
It does.
Protecting the investors and potentially giving them a significantly larger piece of the pie.
It could, and that's why negotiating valuation cap is so important for both sides, especially in the early stages, when it's really hard to predict how quickly the company's valuation might rise.
So convertible debt can be a great option for startups, especially in the early stage.
It can be.
Offering this quicker and easier way to raise money.
Yes.
But it also comes with these complexities.
It does.
And potential pitfalls that entrepreneurs need to be aware of.
Absolutely.
Okay, now let's move on to another hot topic, I think. In the startup funding world, crowdfunding, venture deals dives into this as well.
Yes.
Offering some really interesting insights into how this new model is shaping the fundraising landscape.
Crowdfunding is a fascinating phenomenon.
Yeah.
It's really changed the game in many ways.
It has.
Allowing startups to tap into a much broader pool of potential investors, including everyday people who might be interested in supporting these innovative ideas.
It's like democratizing investment, giving everyone a chance to be part of the next big thing. But how does crowdfunding actually work?
So there are different types of crowdfunding, and Venture Deals distinguishes between the two main types, product crowdfunding and equity crowdfunding.
Okay, so break those down for me. What's the difference?
Okay, so product crowdfunding is what you often see on platforms like Kickstarter or Indiegogo. It's essentially pre-ordering a product or service, often at a discounted price, to help the company get off the ground.
So it's like saying, hey, I believe in this product, and I'm willing to put my money where my mouth is to help bring it to market.
100%.
Okay.
It's a great way for companies to validate their ideas, gauge consumer interests, and raise capital without giving up equity. Now, equity crowdfunding is different. This is where people invest in the company in exchange for actual ownership. Just like traditional investors.
So one's like pre-ordering your favorite band's new album. And the other one's like buying a share in the record label.
That's a great analogy, and Venture Deals highlights that equity crowdfunding in particular has become a viable option for startups looking to raise capital.
And that's thanks in part to the Jobs Act of 2012.
It is.
That we talked about earlier. Which eased some of those regulations. Around securities offerings. Okay, so crowdfunding offers some pretty significant advantages. Like broader access to capital. You know, the potential to build a community of supporters around your product or service. But I imagine there are some challenges too, right?
There are.
What are some things entrepreneurs should be aware of?
So for one, crowdfunding campaigns can be a lot of work. You need to create a compelling pitch, market effectively, and manage a potentially large number of investors. Which can be time-consuming and resource-intensive.
So it's not just about setting up a page and watching the money roll in.
And it's not.
It's like running a mini-election campaign.
It is.
For your startup. A little bit.
And as Venture Deals points out, there are also legal complexities that entrepreneurs need to be aware of, especially with equity crowdfunding. There are regulations around investor accreditation disclosure requirements that you need to follow.
So there are rules of the road.
There are.
Even in the Wild West of crowdfunding.
There are,
a little bit.
Another point that Venture Deals raises is the potential for companies to get stranded.
Stranded? What does that mean?
So it's referring to situations where a company raises a small amount of money through crowdfunding. But then struggles to attract follow-on funding from traditional investors.
So you're kind of setting sail with a tiny raft, hoping to reach a bigger ship. But then you find yourself stuck in the middle of the ocean.
Exactly.
So it's important to think strategically about how crowdfunding fits into your overall funding strategy.
Absolutely.
It could be a great way to get started.
Yes.
But it's not necessarily a guaranteed path to long-term success.
100%.
Okay.
Are you ready to shift gears a little bit? And take a peek behind the curtain at how venture capital funds themselves work?
Let's do it.
It's time to explore.
Let's demystify
this mysterious world.
These sometimes seem like these shadowy figures.
Right.
But I'm eager to understand how they operate.
Yeah.
What makes them tick.
Venture Deals does a great job of pulling back the curtain, shedding some light on the structure and motivations, decision-making processes of these firms.
So let's unpack this black box. What does Venture Deals say about the typical structure of a VC fund?
So it explains that a typical VC fund is structured as a limited partnership.
Limited partnership. That sounds like something I vaguely remember from a business law class.
Yes.
Can you refresh my memory on what that actually means?
Okay, so a limited partnership has two main types of partners.
Okay.
The general partners are GPs.
Okay.
And the limited partners are LPs.
Okay, so who are these GPs and LPs?
Okay.
And what roles do they play in the fund?
So the GPs are the venture capitalists themselves. They're the ones managing the fund, making investment decisions, providing guidance to the companies in their portfolio.
So they're the ones calling the shots.
They are.
The ones who decide which companies to invest in.
100%.
It's like they're the coaches of the startup team.
That's a good analogy.
Okay, so that's the GPs. What about the LPs?
So the LPs are the investors in the fund.
Okay.
They provide the capital that the GPs then use to make investments.
So they're the ones putting up the money, backing the coaches, hoping for that championship win.
They are.
But who are these LPs?
Yeah.
Are they just a bunch of rich individuals?
Well, it can be a mix of different types of investors, and Venture Deals mentions a few. You've got your high net worth individuals, of course, but you also have family offices, which manage the wealth of ultra-wealthy families, pension funds, which manage retirement savings for large groups of people, university endowments, which manage the investments of universities, and even other investment funds.
So it's a pretty diverse group of players.
It is.
But they all share a common goal.
Yeah.
Which is to make money.
Right.
By investing in promising companies.
Exactly.
Okay, so how do the GPs actually make money?
That's a great question.
Yeah.
The GPs earn money in two main ways.
Okay.
Management fees.
Okay.
And carried interest.
All right, let's start with management fees.
Okay.
What are those exactly?
So management fees are a percentage of the fund's committed capital, typically around 2% per year, that the GPs charge to cover the fund's operating expenses.
Got it.
This includes things like salaries, rent, travel, legal fees, all that stuff.
So it's like a subscription fee.
Yeah.
For managing the fund and making sure everything runs smoothly.
Exactly.
Okay.
Now, the real money for GPs comes from carried interest, which is often called carry.
Carry. I've heard that term thrown around a lot, but I never really understood what it means.
So carried interest is basically a percentage of the profits generated by the fund that the GPs get to keep, but only after they've returned the invested capital to the LPs.
So it's like a performance bonus.
It is.
They only get paid if they pick winning companies that generate these big returns.
And the typical carry is around 20%.
Okay.
Although it can vary depending on the fund's size, experience of the GPs, and track record.
So if a fund generates $100 million in profit, the GPs would get to keep $20 million.
They would.
No wonder everyone wants to be a venture capitalist.
It's definitely a lucrative business if you're good at it.
Yeah.
But, as Venture Deals points out, venture capital is not without its risks.
Right.
In fact, the authors highlight an important constraint that venture funds face. They have a limited lifespan.
It's a limited lifespan.
Yeah.
Are you saying venture funds have an expiration date?
They do.
Okay.
Venture funds typically have a 10-year lifespan.
Okay.
Although there can be extensions.
Okay.
But this means that the GPs need to generate returns within that time frame.
Right.
To satisfy their LPs.
Yeah.
And to be able to raise their next fund.
Makes sense.
They can't afford to have their capital tied up in companies that take too long to exit.
Yeah.
Whether through an IPO or an acquisition.
So it's like a ticking clock for those GPs.
100%.
They got to make sure their investments are moving towards an exit within that 10-year window.
Right. And this time constraint really has a significant impact on their investment decisions. They tend to be very focused on metrics like revenue growth, market size, and exit potential.
So it's not just about finding great companies.
No.
It's about finding great companies
that
have the potential to exit quickly.
Exactly.
And generate those big returns that everyone's looking for.
100%. And Venture Deals also mentions this interesting concept called reserves.
Reserves?
Yes.
Is that like a rainy day fund for VC crowds?
Not.
Okay. So we're back and ready to explore this world of corporate venture capital.
Right.
Or CVCs.
Yeah.
They're like kind of the big corporate cousins of traditional VCs, but, with their own set of rules and motivations.
Yeah, and as we mentioned earlier, CVCs are the investment arms of large corporations. So they are looking for financial returns.
Right.
Of course.
Yeah.
But they often have these other strategic objectives.
Right. So it's not just about making money for them. They're also looking for ways to support their core business.
Exactly. So Venture Deals talks about how CVCs might invest in startups that can enhance their existing products or services.
Okay.
Give them access to new technologies or markets, or even help them acquire top talent.
Got it.
So they're really looking at the bigger picture and how these investments fit into their overall corporate strategy.
So it's kind of like strategic acquisitions, but in smaller, bite-sized pieces.
That's a great way to think about it.
A little bit.
But as Venture Deals points out, this approach can sometimes lead to conflicts of interest.
Oh, that's interesting. What kind of conflicts can arise?
Well, for example, a CVC might invest in a startup that's a potential competitor to their parent company that could create a very tricky situation down the line. Right? Or they might pressure the startup to prioritize the parent company's needs over its own. Even if it's not in the best interest of the startup's long-term growth.
So it's important for those entrepreneurs to be aware of those potential conflicts and to really negotiate carefully with CVCs to make sure that their interests are protected.
Right. Do your due diligence. Make sure you're aligned on goals and expectations.
It sounds like you really need to understand the motivations and the potential downsides.
Absolutely.
Before taking money from a CVC.
Venture Deals also highlights another key difference between CVCs and traditional VCs.
Okay.
And that's their approach to valuation and control.
Okay, so how do they differ when it comes to those aspects?
So because CVCs often have these strategic interests beyond just financial returns, they might be willing to pay a higher valuation for a startup than a traditional VC would.
Ah, so that can be tempting.
It can be.
For entrepreneurs who wouldn't want a higher valuation.
Right, but Venture Deals cautions that a higher valuation isn't always a good thing.
Really? I always thought a higher valuation was like a sign of success.
Yeah.
How could that be a bad thing?
Well, if the valuation gets inflated too early on, it can create problems down the road.
Okay.
When the startup tries to raise its next round of funding from traditional VCs.
Oh, I see. It's like setting the bar too high. For the next set of investors.
It is. They might be hesitant to invest if they think the company is already overvalued.
Makes sense. Okay, so what about on the control side?
So on the control side, CVCs often want more influence over the startup than a traditional VC might.
Okay.
So they might want board seats, protective provisions, or even a right of first refusal to acquire the company.
So they're not just looking for a financial return.
No.
They're looking for a strategic foothold in the company.
Yeah, they want to be able to influence its direction and potentially reap the benefits of its technology or innovation.
Yeah, and Venture Deals really emphasizes this can be a double-edged sword for entrepreneurs. It's like, on the one hand, you get access to this large corporation's resources and expertise. But on the other hand, you might have to give up more control and autonomy. Than you'd like. So navigating this world of CVCs requires careful consideration.
It does.
And a clear understanding of the potential benefits and risks.
100%.
Okay, so we've covered traditional VCs, we've covered CVCs, we've even touched on some of those alternative funding models like convertible debt and crowdfunding. But there's one more type of investor, I think, that Venture Deals touches on that I want to discuss. Strategic investors.
Okay.
How do they fit into all this?
So strategic investors are similar to CVCs in that they're typically large corporations looking for those strategic synergies with their core business. However, unlike CVCs, they might not have a dedicated venture capital arm. They might make investments in startups on a more ad hoc basis when they see an opportunity that aligns with their strategic goals.
So like a car company investing in a self-driving technology startup.
Exactly.
Or a media company. Investing in a content creation platform. They're not necessarily looking to become like venture capitalists.
No.
They're just looking for those strategic advantages that can benefit their core business.
100%. And just like with CVCs, it's crucial for entrepreneurs to understand the motivations of these strategic investors and to negotiate terms that are fair and beneficial to both sides.
Well, I feel like we've done a pretty comprehensive deep dive
I think so.
into this world of venture capital and startup financing.
We have.
We've covered, all the different players.
Right.
The key terms, alternative funding models, even,
Yes.
some negotiation tips.
We did.
It's been quite a journey.
It has.
Venture Deals really provides, I think, a great roadmap
It does.
for navigating this complex landscape.
Absolutely.
And it really emphasizes that this is an ongoing process of learning and adaptation.
100%.
Right. It's not just about understanding, the mechanics of a deal.
Right.
It's also about understanding the people involved. Their motivations. And how to build those strong, lasting relationships.
Absolutely. And as the venture capital landscape continues to evolve with new funding models emerging and the balance of power shifting between founders and investors, it's more important than ever for entrepreneurs to be informed, strategic, and adaptable.
It's a dynamic and exciting world to be a part of.
It is.
Full of challenges and opportunity.
For sure.
Well, I think you've given our listener a lot to think about as they embark on their own startup journey.
Yeah.
Thanks for joining us on this deep dive.
It's been my pleasure.
And to our listener, we wish you the best of luck as you navigate this exciting world of venture capital and startup financing.